Moving on to leverage and margin trading. So some markets and exchanges offer leverage, which allows traders to borrow capital to fund their contracts and positions. Leverage grants exposure to large positions without the need for funding the large position up front. Essentially, you can borrow money to trade with. Traders using leverage don't need to match the total value of the contract. Leverage can be used to secure the contract with a smaller equity stake known as the initial margin. Now, if the position moves against the trader, a maintenance margin level must be maintained. Maintenance level base valuation of the trade of the position that has to be maintained. Otherwise, the position will be liquidated and closed out. So there's a few key terms and few key things to know when trading various derivatives and using leverage. The quantity, this is the number of contracts in an order or in a position. The entry price is the average entry price of the current position. Liquidation price, the estimated price at which the position will be liquidated or closed out. The unrealized P&L, this is the unrealized profit and loss of the current position. Now this becomes realized when closing the position out. And then the realized P&L. This is the realized profit and loss of the position. Trading fees and funding fees are also included in the realized P&L. So you get to actually see and calculate what the total profit was after any fees of opening the position, trading fees, funding fees, and any sort of shifts in the market once it's actually closed out, and that unrealized profit and loss finally becomes the realized profit and loss. Then there's also the margin. This is the minimum amount of funds you must hold to keep a position open. Once the margin balance drops below the maintenance margin, the position is liquidated. Here's an example of a Bitcoin perpetual contract, a futures contract. We see there's only one contract here. We see the value is 9,211 USDT, US Tether. The entry price was about 9,312. The mark price, 9,211. Liquidation price, the margin amount, so it's 0.99x, so small amount of margin. Relative, I mean, some people are trading with 5x leverage, 10x leverage, which essentially is, all right, so if this person entered with a position of 9,211, let's say, they could do 5x leverage, and they can multiply their price of their margin price of their base value of what they're actually using of their own capital, let's say 9,000. They're using 5x leverage. Now they're trading with a 45,000 trading position, right? Some exchanges offer 10x leverage. Some offer 50x, 100x. Now the big thing to worry about with leveraged positions, I mean, there's many things to worry about, but the biggest thing I would arguably say is liquidations and understanding how liquidations work on the exchanges. So liquidation is the involuntary conversion of assets into cash or equivalent, such as stablecoins. Basically, you're forced to cash out and close the position. Forced liquidation occurs when the trader is unable to meet margin requirements in a leveraged position. This applies both to futures and margin trading. Traders are able to monitor and maintain their positions by tracking the liquidation price in relation to the contract mark price. Now, if the contract mark price drops below the liquidation price when long, or if it goes above the price when short, right? Remember, if you're shorting the market, you want price to go down, but if price goes up above your entry price and above the liquidation price, then the position will be closed out and your account will be liquidated. Now, when trading with leverage, liquidation price is key to track. The higher the amount of leverage used, the closer the liquidation price will be to your entry. Now, consider larger amounts of initial margin will typically be granted a larger buffer between entry and liquidation prices compared to positions with smaller initial margins. So this basically means if you're using more capital up front, you will have the ability to set a larger buffer between the entry and liquidation price. So let's say you're longing Bitcoin, you entered at 10,000, and you're given a liquidation price of, let's say, 9,500, and you're only using $10,000 of your own money, and you want to use 10x leverage, right? So now you're trading with $100,000. Now, if you were to use more initial capital, initial margin, so let's say instead of you just using $10,000 of your own money, maybe you want to trade with 20,000, right? You'll be given a larger buffer between your entry and liquidation price. So that means since you're going long, you'll have the ability to set a lower liquidation price. Maybe your liquidation price at that point would be $9,000, which gives you a bigger buffer between your $10,000 entry and your $9,000 liquidation price. So let's say you had $50 in your trading account. You could enter a leveraged long position in the Bitcoin to Tether market with 10x leverage, meaning that your position size will be $500. Now, the $500 would consist of your $50 margin and the $450 that you borrowed for leverage. Now, if the price of Bitcoin goes down 10%, your position is now worth $450. Any further losses would impact the borrowed funds, right? So you have your $50 that you put in up front, and if Bitcoin goes down 10%, your position is now worth $450. And now that's starting to threaten the integrity of the borrowed money. Now, lenders and exchanges, they don't allow funds they leverage out to be affected. They're not in the business to lose money. So automatic stops are put into place to liquidate the entire position to protect their capital. Forced liquidation typically has additional liquidation fees attached to incentivize traders to manually close positions before that liquidation mark. So this probably, if this person in this particular situation, let's say they borrowed $50, they're using $50 of their own money, they're using 10x leverage, they're borrowing $450. If the price of Bitcoin were to go down, it probably would not even have gone down to 450 because that's too much of a risk for the exchanges. They probably would liquidate the account maybe at 9 or 8% depending on the exchange, and this will vary depending on the size of margin as well, and I believe account history can play a role as well. But the main thing is that because this person's using such a small amount of initial margin, just that $50, there's much smaller leeway, right? The position goes down, they're not giving a buffer. If Bitcoin goes down such a small amount, they will pretty much be liquidated, rather than if the person was using, let's say, $5,000 or $50,000 and they use 10x leverage, they'll be given a much larger buffer that the position could go down and still not be liquidated. Here's an example from Poloniex. This is their trading market example. Here are just various contracts that they support. This is their US Tether, USDT, the Tether collateralized positions, and they accept the margin in USDT. Their P&L settlement coin is in USDT, and they show maximum leverage position. So they actually offer 100x leverage, and they only support that with Bitcoin to USDT perpetual contracts. Now, if we were to go down to 50x leverage positions, they start to offer a greater variety, such as Bitcoin Cash, Bitcoin, Ethereum, Yearn Finance, Uniswap, Link, TRX, and then more offerings at other breakpoints in terms of max leverage. Right, we see XRP offered at a maximum of 20x leverage as well. Now, there are risks to trading futures. Trading cryptocurrencies already involves a great deal of complexity and risk. Using leverage and collateral to trade cryptocurrencies compounds these factors. Now, comparably, small price fluctuations will have a much larger impact due to leverage amplifying gains and losses to your account. The market price of futures contracts doesn't affect the price of the underlying asset. The futures contract price will fluctuate based on the value of the underlying asset, supply and demand, and other market factors. For example, a small price decrease on a 100x leveraged contract position and on its underlying asset could result in a 100x loss on your leveraged position in the product. Even in times of low price volatility, it is important, or it is possible for a trading account balance in the futures market to be liquidated. So it's always something to keep in mind. You always want to be aware of your liquidation levels, your margin calls, and your margin balance. Pros and cons. Pros include the possibility to long or short depending on the situation. You can capitalize on both movements of the market. You have access to leverage trading. You have access to borrow funds to open up greater positions. And you can also hedge in a variety of ways. Let's say if you own Bitcoin, you can open up a short position and capitalize if the price of Bitcoin goes down. And if the price of Bitcoin goes up, you still win because your long-term holdings will increase in value as well. Now, the cons, the downsides, it is considered high risk and even higher risk on an already risky and volatile asset class. So be warned, it's not something that I advise, especially using high amounts of leverage. Squeezes can eliminate positions quickly. So if price is extremely volatile on one day, and let's say there's a buildup of shorts in the market, and there's an extreme buildup in shorts, and someone plans to make a large purchase. Well, that's going to liquidate some of those positions, and as a result, they're forced to buy, right? Remember, short contracts are an agreement to buy at a later date. So if they are forced to liquidate, and there's auto liquidations, they are forced to buy immediately on liquidation. As a result, the price will continue to go up, and this is what we call a short squeeze. Now, if prices are continuing to go up and there's still this accumulation of shorts, it's going to continue to liquidate those short positions, and as a result, they're buying more. The price keeps going up, and it continues to liquidate more and more short positions. And this is where things can get out of hand, and we start to see these massive pumps in Bitcoin and these huge rallies, and also these huge dumps as well, because if there's a buildup of people longing and there's a massive sell, that can trigger a massive sell-off where these long positions are agreeing to sell the product at a future date. If they're liquidated, they have to immediately sell, and as a result, the price can quickly dump as well. And as a result, the general high volatility of Bitcoin and of crypto is definitely a con to futures trading in crypto as well. And then also the fees and the funding rate. Typically, if price is going in a certain direction, most people aren't doing that, right? For the most part, people are typically behind the curve, right? If Bitcoin is going up in value, people aren't the first to capitalize on it, right? That is not the majority of times. Usually the mass mainstream, the general consensus is always, let's say, a step or two behind of what's actually happening in the market. And the people that are really on top of what's going on in the market and who are right on top of their game, they're the ones who are first to strike and typically have the best positions. As a result, we have to keep track of the funding rate and general fees and the balance of longs and shorts as well. Here's an example. This is from Kraken. This is their futures contract details. They offer Ethereum, Litecoin, Bitcoin Cash, Ripple, and Bitcoin futures on Kraken. And here are their various currency pairs, various time frames with perpetual, monthly, quarterly, and semi-annually. So every maybe 6 months, every 3 months, maybe every 1 month. We also see the contract to unit size. So each contract is about $1. On this particular situation, the collateral is accepted in Bitcoin and different types, inverse futures contracts, leverage up to 50x in most contracts, and fees as low as 0.01% maker and taker based on 30-day volume as well. And here are some statistics. This is from Binance, looking at the general volume of their contract sizes. Here we see, in particular, we do see there's a significant amount of volume in their Bitcoin to Tether perpetual contracts offerings, right? This is about $15 billion in trading volume in 24 hours in regard to their Bitcoin perpetual trading. Now, in contrast, here's Kraken. We do see different and not as much volume, general lower open interest, lower volume, and same thing with FTX as well. FTX sees about 3.4 billion compared to Binance's 15 billion trading volume. So it is a notable amount, $3.4 billion traded in 24 hours. But it's definitely not as high as Binance. It's something that we want to keep in mind of. And, also when you're shopping for different exchanges to use, typically more volume is better. There are situations where trading in other markets can be useful depending on maybe your position size or your region, maybe access, maybe there's certain incentives that the exchange offers. And this is something that will vary from trader to trader.